Welcome to No Nonsense. My goal is to have one video a week, but sometimes the old man has to take a nap. So, if you want to know when I've uploaded a video, you need to subscribe, and then you'll be notified. The other thing is, if you have any questions, just put them in the comments. I will answer your questions. There are no silly questions. There sometimes are stupid answers, and I'll probably give you that from time to time. But go ahead and ask away. Now, today, I want to talk to you about the 5 things, in my opinion, that distorts your stock market trading. One of the things that everybody's all concerned about, and it's not just here in the Philippines, it's on every stock market in the world, and that is foreign buying and selling. We want to know whether there's foreign money coming in or foreign money going out. And you know what's interesting about it? I looked at the stock exchanges around Southeast Asia, and basically the percentage of foreign involvement, foreign trading in the market is about the same across the board. Everybody says that about 50% more or less of all the activity on all of these exchanges, Thailand, Malaysia, Indonesia, not Vietnam, of course, is foreign money. However, I know as a fact that that number is a bit inflated here in the Philippine Stock Exchange and maybe on the other exchanges as well, because foreign designated accounts don't necessarily mean that it is foreign money. It can be a foreign oriented account, but it doesn't necessarily mean it's foreign money. And let me give you an example. If you own a listed firm on the Philippine Stock Exchange and you sit down to talk with me about any purpose, I'm going to ask you whether or not you have a foreign stock brokerage designated account. Now understand, these 5 things that I'm going to talk about, there's nothing illegal about any of them. There is, in some cases, reportorial requirements, meaning that like obviously when an owner sells personal shares, it has to be disclosed. However, this foreign account thing is right on the borderline between being legal and illegal, because an account, the beneficial owner of an account must be not one of the insiders, a director or a majority shareholder, large shareholder, or whatever. And sometimes that line gets blurred a little bit. But I know it's being blurred, just like I know that some people don't stop at stop signs at 2 o'clock in the morning, or traffic lights for that matter. So a foreigner in the U.S. can set up an account that's foreign designated, and every time they make a transaction, it's shown as foreign buying or selling, even though that person may hold a Philippine passport as well as American citizenship or whatever. But the reality is there's a lot of companies set up overseas by listed firms that trade the stock market, like I said, a little bit borderline between legal and illegal. And it's almost impossible to catch. Because if you set up a foreign company, say in Hong Kong or Bahamas or wherever, and you've got all these attorneys that are the shareholders and board of directors and everything, the stock exchange through the CMIC, the Capital Markets Integrity Corporation, is going to have an impossible time to track down whether or not that's a legitimate foreign money account. As long as the shareholders, as long as the incorporators have an overseas passport, it's going to be approved. The reason for that is, if I was a nefarious owner of a listed company on the PSE and I wanted to show that foreigners were buying my stock, I might have my brother-in-law pick up the telephone to call the Bahamas and ask that company to buy shares. So the next day it looks like, oh my gosh, a foreign account bought 1 million shares of my company, which we're going to like, you're going to like, the stock market is going to like. Does it blur the line between legal and illegal? Absolutely. Is it often over the line? Also absolutely. Does it distort the trading? Does it distort your trading and my trading? Absolutely also. Very little can be done to stop it. Very little can be done to change it. That's why when people say, when I read the newspaper, well, there's one brokerage company out there that always posts at the end of the day which companies were foreign bought and which companies were foreign sold. I'm going to tell you right now, I can look at that list and know which ones are bogus. Sorry, I've been doing this too long. I know the reality. Now, the other thing that distorts stock market trading is what's called done-through transactions. Now, you may not even be aware of it. As an average retail investor, you're probably not. But that's when I sell shares from my XYZ brokerage account, but the order is actually executed through ABC brokerage company. The transaction is done through. Now, this is one of those cases where it has to be reported the next day or the same day or whatever. So you've been seeing XYZ company buying and buying and buying the shares of this particular stock, but you never see them sell. However, they can sell secretly, at least to you and I, by doing it as a done-through transaction. Does it distort the market? Of course it does. Is it illegal? Absolutely not. There are reporting requirements on it, but that is something that we need to see. See, along with that, every month there is the Philippine Depository Corporation puts out a list of all the top 100 shareholders of every company and also puts out a list of which brokers own which stock. So you saw that XYZ had 20 million shares of the company that you're invested in May, and then when the June report comes out, you see that instead of 20 million, you only have 5 million left. Where did the shares go? You never saw them sell. Done through transaction. Not illegal in the slightest. Not really unethical because you have to report it. But for the average retail investor, it distorts the market. Now, another thing that's commonplace around the world that you may or may not be aware of is iceberg orders. Now, here's how it works. I want to sell 1 million shares of a company, but I know if I post selling of 1 million shares, everybody's going to go, who's selling? Why are they selling? What's wrong? What I do is I put in an iceberg order. So instead of showing 1 million shares selling, it'll only show 100,000 shares selling. Or, for example, if I wanted to sell 100,000 shares of a thinly traded stock, I put in an iceberg order, but only showing 10,000. Now, here's how it distorts the market, and absolutely not illegal. You think, as a small retail investor, that, oh, there's only 5,000 shares selling at 10. So once the 5,000 shares at 10 is sold, then the stock's going to continue going up and up because there's very light selling pressure. So you go in, you buy the 5,000 shares at 10, thinking, man, I'm the first in line and it's going to go higher. And all of a sudden, there's another 5,000 shares posted selling. That's part of the iceberg. Once the amount visible is executed, then the shares from the iceberg are put in line. Not illegal, not unethical, common practice all around the world. But it distorts the trading. So if I see on a stock a selling order that's small, I'm not going to buy into it because I want to see what happens when somebody else buys. So honestly, I'll let you buy it. And then when I see another 5,000 come up immediately, maybe that's an iceberg. So I'll wait again. And if another 5,000 share order comes in to buy, and the two brokers, or the brokers on the two 5,000 share order is the same, then I know it's an iceberg. And instead of having to only go through 5,000 shares to break out and go higher, now I know there's a big chunk of shares. And if I'm going to do iceberg trading and I want to sell 250,000 shares, I'm going to put 50,000 at one fluck, 50,000 at another fluck, 50,000 at another fluck higher, all with 5,000 share showing. So as people buy the stock up, I'm first in line, I'm going to get executed. But what that really does, come on, it limits the upside potential. It caps the price of the stock. And you and I don't know it because it's an iceberg order. And here's another thing that also relates back to the done-through idea. It distorts the market. It distorts the trading. We trade on the Philippine Stock Exchange what's called a T+3 settlement. And what that means is you buy the stock today, but you don't have to pay for it for 3 days. All right, sounds reasonable. One thing that's kind of interesting, why the hell does it take 3 days to pay for your stock order? You can practically buy a car on Gcash instantly. But when it comes to the stock market, you have 3 days to put the cash on the table. And what else is interesting is I can't find any other stock market in the world that does a T+3. Everybody does T+2. Not illegal. But here again, there's a gray area because if I have a close relationship with my broker, I can buy T+3, meaning I buy today, sell it before the settlement date, and take the profit or the loss without ever having had to put up any cash. I can buy 1,000,000 pesos worth of stock, and as long as I liquidate that position in T3, I have not had to put up any cash at all. Is it illegal? It's against the rules. You're not supposed to be able to do that. But it's not illegal because that's what the stock exchange says, T+3. You can buy a stock today and you don't have to pay for it for 3 days. But that's going to change. And it distorts the market because I can buy the stock, sit on it, and I don't even have to pay for it until I see if it goes up. If it goes down, I have to cover the loss, but I don't have to put up any cash. That's like going to a restaurant, ordering a meal, not having to pay for it unless you really like it. At the end of August, that's going to change, and we are going to come in line with the rest of the world, or at least the rest of regional markets, which are all T+2. The significance of this is no longer can a guy buy a stock on Friday and wait until Wednesday to cover the position. What the result is going to be, I cannot tell you, but I will tell you this. There are lots of people out there that are trading T+3. And I think when they have to pay for the shares within 2 days, it's going to make a difference. Now, what the difference is going to be, I cannot tell you that. But this distorts the trading. If you can buy something without paying for it, that puts a big damper on genuine price development. If you could buy something without paying for it, wouldn't we all do that? Now we can't, 3 days. But when it goes to 2, it's going to be a lot different. The other thing, the final thing in my opinion, that distorts the market is this idea of public float. We got a situation right now with SP, I call it spinach, suspended because they do not meet the minimum public float requirements. Now, what's the public float? The public float is the amount of shares that are available in the public to you and I to create liquidity. If one guy owns all the shares, there's no liquidity. So there's a rule. And Spenick violated the rules, and as a result, the shares are suspended. Now think about it. I own Spenick shares from a month ago, and suddenly I can't trade it. And it's not my fault. I want to sell the shares right now, but I can't do it because it's suspended. And why is it suspended? Because the company allowed the public float to go below the legal limit. I suppose I could sue. I suppose I could wait a while. But in the meantime, my investment, my money in that stock is tied up. And that in and of itself distorts the market. It distorts price discovery. What's the real value of Spinach? I have no clue. Because there's no market in it. And if I could sell it today, I might buy another stock that would go up because I'm buying it. It's not the fault necessarily of the exchange because they have very hard and fast rules. And that's why Spinach is suspended. But it takes time to go from the actual public float going below the limit until the regulators find out. It's not instantaneous. And maybe by the time the regulators find out, whatever it is, hours, days, the stock will be suspended, and current shareholders honestly are left holding the bag. Do I blame the company? Not particularly. It could be an oversight. I doubt if it's deliberate. No company wants to see their shares suspended. But these are the things that distort the trading on the market. It distorts price discovery, and it distorts your reason for being in the market, which is to have a legitimate price discovery based on the buyers and sellers coming in and out, based on information that theoretically everybody knows. And that's not good for any of us. It's not good for the PSE. It's not good for the listed companies. And it sure as heck is not good for the investors.
Well, that definitely wasn't